Is the market rotation over, and is it time to buy this most hated asset? Well, I've been talking a lot about the market rotation, meaning money is moving from one sector of the market and into other sectors. But now this rotation seems like it could be over, or is it a slight correction? Also, one of the most hated assets, we're talking about bonds. For the first time ever, we've seen stocks and bonds falling at the same time. But is it time to think about buying bonds again? These are some of the topics that we're discussing with today's guest. We're talking with Alf Macro. He ran a $20 billion portfolio, and now he is here to speak with us, talking about central banks not printing money, talking about the double whammy that we're dealing with from the central banks, talking about the price of money and how the central banks affect everything, talking about bonds and bombs. Bombs meaning big problems in the economy from the Asian DXY, Japanese bonds, and European bonds. Talking about energy, what's happening with the Ukraine crisis. Is Europe going to blow up, disintegrate? Will the United States have to bail them out? And so many other topics. And we don't leave until Alf gives us some recommended trade ideas. You don't want to miss this interview with Alf. It was an amazing conversation. Let's go ahead and just jump right into it. All right, Alf, welcome to the channel. I know this has been a long overdue interview we've been trying to put together for some time. I'm super excited about it, so welcome.
Mark, my pleasure to be here. How are you doing?
Man, I'm doing great. While the world is melting down, I'm still in my little bubble, and I'm holding up. But I got a lot of things to talk about with you today. Probably have, typically I have too much of an ambitious outline here in front of me. We'll see what we can get through. First of all, just our little pre-conversation we had. I wasn't recording. Sometimes the best conversation comes in the pre-recording. So in the pre-recording, you said 6 months ago you were running a $20 billion portfolio.
True that.
One, what type of portfolio was that you were running? And two, why are you not running that anymore?
Yeah, a great question to start. So
just jump right into it.
sure. So the portfolio was a large institutional fund within a large European bank, ING, it's the name of the bank. And effectively it was a portfolio of mostly fixed income instruments, so bonds, but also equities, FX, credit spreads. A bunch of institutional asset classes, let's say. And so it was a relatively active one against the benchmark to try and generate some returns out of it. And why am I not running that anymore is because I did that for a while. And at some point I grew quite numb to the feeling of only basically have to run money and not being able to share all that I wanted to share with people at the end of the day. And then I just decided to go through the financial education journey to the, sharing these crazy markets with you guys and just decided to basically change what I was doing. It's also pretty tough, to be honest, and tearing to run money for a while. And I still want to do that, I guess, in the future. But I just wanted to share more knowledge as I could do with the broad audience, which is what I've been doing for the last 6 to 7 months.
Yeah, well, I appreciate that. I appreciate it for the information they get shared with me, but I think ultimately I try to say that I have a sign behind me. I don't know if you can see it, not from the camera angle you're at, but lighting brush fires. And so it's about us like sharing information, trying to wake more people up, and hopefully those people go share that information and so forth. And the more people that we can open their eyes and help navigate this, I think the better. So appreciate that. Now, like I said, I have a whole list of questions, and now I'm coming up with some that I don't have written down because you sparked them. Your shirt. Central banks don't print money.
Correct.
Now, we use that. I think most people understand that that's not true. But of course, we have the memes of Jerome Powell with the money printer, and
Yes.
things like that.
Yes.
Central banks don't print money. Explain that for us.
Yeah. So, Mark, I have basically spent the last 15 years trying to understand monetary mechanics. It sounds pretty complicated, and a lot of people have that wrong. So, just wanted to get into the weeds and study the system. What is money? How does that work? And I found out, I think, 3 important things. The first is there are different forms of money, Mark. Like the money we use is very different that the money commercial banks and the central banks use. There are basically two different tiers of money. Money for the real economy, money for the interbank system. And so once you understand that, a lot of things become much more clear, Mark. And so central banks print money, yes, they do, but they print the money that remains stuck in the interbank system. Those are called bank reserves. We can explain a bit more how that works. The other form of money, the one that we use, our audience uses, the people listening are using, are basically cash and bank deposits. And I should say bank deposits and cash, because cash today only represents about 2 to 3% of transactions out there. All of it's done with bank deposits. We just wire each other digital bank deposits, let's say.
Just marks on a
So
ledger.
the two tiers. Correct.
Yeah.
So basically banks on the back of our transaction credit and debit each other on a ledger. That's all they do, right? And so central banks do not print that kind of money. They literally can't. With QE, things got a lot more interesting because people like then to make a lot of interaction and interconnections between the two tiers of money. But the two tiers of money almost never communicate with each other, directly at least. Or at least the central bank cannot make them directly interconnect with each other. The guys who print the money we use, Mark, are commercial banks and the governments under certain circumstances. So the people we should look the most after for money printing is the United States government or your domestic government and commercial banks.
So one problem I have with some of these intellectual economists is I believe they're factually correct while maybe potentially being intellectually dishonest. And so when we start splitting hairs into some of these things, they're factually correct, yes, but maybe it's not. It's misleading, we'll call it that. So what do I mean by that? So I've recently spoken at several conferences. I was at one, I'm not going to name names, but with somebody from Europe, one of the biggest names in central bank. I'm going to name his name, Professor Richard Werner. And he knows more about the inner workings of the central banks than he's forgotten more than I'll ever know, right? Shout out to him. I love his work. He gave an amazing talk talking about why the problem that we have with banks centralizing, that we need to keep the banks decentralized. Amazing talk. But anyway, I was on a panel with him, and he was asked to talk about the differences of QE. So to the point you're making, the central banks issue reserves to the commercial banks lend out. So he said, hey, what's the difference with QE from 2008 and 2020? And then how is it different in Japan versus the United States? And he went into this long, in-depth, intellectually, factually accurate conversation. And he summarized it, and so the central banks did quantitative easing, but it didn't put money into the actual people's hands, and so that's why it wasn't inflationary. That's how he ended it. So it wasn't inflationary. And I said, hang on, let me ask a question. I said, so let's see, since 2008, they've done all this QE. It wasn't inflationary, but yet homes are at all-time highs, stocks are at all-time highs, gold's at all-time highs. This was in January. Cryptocurrencies were still mostly at all-time highs. So how is that not inflationary? Well, those are assets. That's not prices, right? And so it's like, well, I guess it comes down to definitions, and maybe it's factually accurate, but is it misleading? I mean, if prices went, I said, so I'm a consumer, I bought a house. Was that a consumer price that went up, right? and then on top of it, then they would say, I got into a conversation with Jeff Snyder at a conference I was speaking at last weekend, and he was also saying a similar thing, that the central banks said that they were going to do something, but look, they haven't even done anything yet, so they have no effect. I said, yeah, but just them saying they were going to do something has had an effect. So then there's like, well, is it direct? And then this is what you had said here. They never communicate with each other. Well, is it direct or indirect? One way or another, it's moving markets. Would you agree with those things? Or what am I missing there?
I agree with 2/3 of what you said.
Yeah.
So I agree with, yes, central banks definitely do move markets. Yes, central banks are definitely asset inflationary or asset deflationary with their decisions. They can really be. Well, we're witnessing some of it today, for example. Some of their monetary policy posturing, let's say, So Jeff Snyder said, look, they didn't even do much. Well, I disagree with that point. And we can explain, Mark, why the central bank's biggest weapon is actually posturing. It's actually it's so-called forward guidance. It's basically telling us what they're going to do. And I can tell you this from first-hand experience, because when I met all these central banks at conferences, most of them actually admitted that their biggest weapon is exactly that, is telling us what's going to happen.
Yeah.
We can describe how that actually plays into our decision-making as consumers, as corporates, maybe later on. But I do disagree with Jeff Snyder there. I do agree with you. I also agree on the fact that central banks are asset inflationary, and how that works literally. Let's go through that for a second. When a central bank does QE, it expands their balance sheet. So on the asset side, they buy bonds, or let's say bonds, let's make it this, they buy treasuries. And on the liability side, they expand their balance sheet by creating reserves. So it's a tier of money that we can't use, you and I can't use, but they can use. So they use that and they buy treasuries. Cool. So they buy treasuries from whom? That's the first question we should ask ourselves. So let's, for a second, make again an easy example. They buy it from a bank. So JP Morgan had treasuries before on the asset side of the balance sheet. Now they have to sell it to the central bank in this stylized example. So the JP Morgan balance sheet didn't actually increase or decrease, it just changed its composition. It had treasuries and now it has bank reserves, because remember, I told you before, JP Morgan can use bank reserves, you and I can't. It's only banks and central banks that can use it. Now, the part many people miss, because I worked in a bank for a long time, what is JP Morgan going to do with these reserves? Because people generally, what I don't like about economists, and I agree with you, is that they tend to be sometimes very, how can I say this, not very concrete. So you need to ask yourself more questions. What is JP Morgan going to do with these reserves? Well, these reserves are basically an inert form of money only for banks. They can't do much with it. They have a regulatory, let's say, a decent treatment when it comes to regulatory liquidity. So the regulator tells you it's good to have reserves, it's fine, they meet all the ratios, they look okay. In reality, they return nothing. They give you no risk that you can use maybe to hedge some other risks you're running. They're just an inert form of money. So what's going to happen is that if you own too many of those, you're going to try to get rid of those. So JP Morgan can try to get rid of these reserves and buy bonds back. So they will try to get rid of these reserves, lend them to other banks, and in exchange try to get some bonds. Because bonds, you know what, they give you some return that is higher than these reserves. They give you some interest rate risk, some credit risk that you can try to warehouse on your balance sheet. They give you some risk-return profile. Reserves have no risk-return profile. But wait a second, if all banks now have a lot of reserves after QE, Mark, then what's going to happen is that every one of these banks in the United States of America are going to at some point try to do the same. They're going to try to get rid of these reserves and instead replenish their balance sheet with bonds. So once treasury yields are then gone, what are they going to do? They're going to buy the next good bond, which is a corporate bond. Because some corporate bonds are very, very well treated when it comes to regulation. The regulator tells you can buy an Apple-issued bond, a Microsoft-issued bond. We're okay with that. It's okay for regulatory perspective too. So they're going to buy all these bonds. So credit spread contract. So what's next? When that is contracted, what are you going to look for? You're going to look for higher yielding bonds, and so on and so forth. So as all of us actually do that, including mortgage-backed securities, when banks go and buy mortgage-backed securities, they're extremely well treated from a regulatory perspective to get rid of their reserves. They will basically incentivize the production of new mortgages at lower and lower rates. And as they do that, house prices over time will normally move up a little bit. So I do agree with you that there is a portfolio channel, a rebalancing effect through which central banks have a large impact on asset markets. They reduce volatility, they incentivize everybody, every actor, starting from banks, ending to pension funds, asset managers, to us, to take more risks.
Exactly.
And we all got suckered into that trade. And that trade basically seems to work perfectly because in a bull market, everybody's a genius. It's always been the case.
Yeah.
But then what happens is that as soon as either the economy slows down or some idiosyncratic event happens, or like now, we get a double whammy of the government telling you, I'm not going to print any new money because, guys, you had too much. I'm going to stop printing those. and the Federal Reserve tells you on top, well, actually just give me some of these reserves back, because that's what quantitative tightening is. Just give me some of these reserves back, you can't have them anymore. And then what happens is that you have just the opposite effect, and we are just witnessing that right now.
Yeah. So that's what I'm talking about, being factually correct but somewhat misleading, which is you started out talking about how the central banks don't print money, per your shirt, and so they'll give reserves to the banks, and that money may or may not get into the system. It may or may not. But
Yeah.
if the banks believe that the feds are going to continue to lower their reserve requirements or backstop them even more, then the banks would be more encouraged to lend money out. So even though it doesn't communicate directly one-to-one, it still influences the other potentially.
So Mark, here it does influence the ability of bank to take risks. The more reserves there are in the banking sector, the lower the volatility, the more these banks are going to be incentivized to get reserves away and buy assets with it. Mm-hmm. So we discussed about buying assets, corporate bonds, right, whatever it is. Even, I should add, certain equities are eligible from a regulatory perspective.
And then what happens when they buy those bonds and those equities? It puts more money into the system. Now those corporate bonds have more money to spend in the system. And so one way or another, like a long way around, it still maybe does the same thing?
Not really, because those bonds haven't increased in size. They've just changed in price.
Okay.
So there are no new bonds in the system. The corporate doesn't get a bigger balance sheet because of that. It just gets more money. Let's say its stock or corporate bond becomes more valuable. So what I want to make clear for people is that more money for us, Mark, us meaning consumers, mm-hmm, effectively means that our balance sheet needs to become bigger. Mm-hmm. And the way we have more bank deposits to spend, that's how we actually generate inflation. We have a larger bank account at the end of the day. Mm-hmm. The way we have a larger bank account is that if a bank lends us money, or if the government all of a sudden, like it did in 2020, says, hey, Mark, Alf, here is a check, have fun.
Helicopter.
Right? That's the way. And reserves, that's another thing I really want to stress. If banks, Mark, have $1 trillion of reserves or have 200 reserves, I'm just shooting numbers to give you the magnitude, the relative magnitude.
Yeah.
It does not impact their ability or willingness to lend money away. And I've been in a bank, so I've really seen that. It's a weird process. So the process works as follows. When a bank has to make loans, they look at three things. Let's say Mark wants to borrow, right? Shows up at a bank. First of all, you need a willing borrower. That's super important. Banks cannot just lend away money. It's not like the government. If the government wants to cut taxes, it doesn't ask you permission to do so, Mark. It literally cuts your taxes or sends you a check home. It's a unilateral decision. Great. But it's a unilateral decision, right? Yeah. You don't have an immediate say about that.
Yeah.
In lending, you do. You have to show up at a bank, right? So Mark shows up. He wants to borrow. First thing they do is they look at your credit worthiness. So they make some analysis and they say, Mark is good or not good. Okay. Second is the yield they can generate by lending you money. And that's important because they're going to be taking some risks. You might default, you might lose your job or whatever that is. Mm-hmm. So if risk-free rates like treasury yields are very low and credit spreads are very low, then it's likely that banks won't make much money by lending you money, right? So that already brings them to think twice to check your creditworthiness against the loan yields. The third important thing is regulation. If the regulator goes there and says, hey, every dollar you lend, you need to attach X capital against it because, Mark might default or whatever other things. If this regulation becomes tighter, then the return on equity, the return on investment they make by lending you money becomes smaller, which disincentivizes them to lend. Have I talked about reserves so far? No, I haven't. Yeah. Because the amount of reserves they have, it's such a, how can I explain this? So low in the hierarchy of their decision making compared to the first three things, it's almost irrelevant. Reserves are important because they need to settle payments at the end of the day. If they lend you money and you go and spend this money and make a bunch of transactions with another bank and they need to settle on the back with the other bank, which is on the back of these payments, they need reserves to settle these payments. But they don't need reserves to lend money to you. Commercial banks literally create money out of thin air every time they lend. Right. It's the process of credit creation. And they can increase your balance sheet, my balance sheet. When I buy a house, that's the example I always do, I don't have the money to buy a house. Literally, I go and take out a mortgage. It means the bank credits my account with money that didn't exist before.
Right.
It's funny, but that's how it works.
Sure.
You show up with this money at the notary, you buy the house, all of a sudden you had the money. No, you didn't. It's just credit. It's new money being created.
Right. Yeah, and it's good to understand how that works. So I appreciate you breaking that down. So if we continue on that thread, central banks increasing the money supply indirectly through the banking system, that takes us into several areas, and I want to end up at one, which is the future of this banking and CBDCs, and we'll get into that. But I want to start at the top. And we'll see how much time we have because, like I said, maybe I'm too ambitious here. But if we look at where we're at today, so I saw a chart recently, and it showed the central bank balance sheets, and it's moving basically like in perfect lockstep with the S&P 500. So we can see as the central banks have increased their balance sheets, then the markets have also increased. We've been operating on this Fed put. A lot of people have been talking about the Fed put, and through this last 12 years of easing monetary conditions, et cetera. But now, we all know the central banks are now trying to reverse that. So the Fed says they're committed to getting back to 2% inflation, and they're prepared to crush demand, I guess, in order to do that. And so let's talk about that specifically. So I think to the point that you're making, or that we were both discussing, they haven't actually done a lot, but they've been talking about doing a lot. So they've given us this forward guidance, like over the next couple of years, we're going to raise rates, which they've done a little bit. We're also going to do QT, which I don't think we've really seen yet, but the markets have responded in a big way.
Mm-hmm. Yeah. So how this works, it's, again, another interesting thing of bond markets. Most of my portfolio used to be in bonds, which is seems like an esoteric thing to understand, but it is the basic asset class above which and around which all other asset classes rotate.
It's
very
debt.
important to
Just
understand.
debt for most people, right? It's just debt.
Exactly.
Yeah.
And that's what we discussed before. Like that new credit is what oils our system. Mm-hmm. Like the more debt we create, the more wealth effect we have because we feel richer. If you got a mortgage, you could buy a house of $1 million that otherwise you can't buy. Mm-hmm. And underlying that transaction, there is debt. And bonds effectively are the price of that debt. So it's extremely important to understand that, Mark. And how it works with this forward guidance is the Federal Reserve shows up and says, we're going to hike. We're going to hike to 3%, 4%. Now, the bond market, when they heard in November 2021 that they were changing their tune, do you remember there was all of a sudden Powell showed up and says, whoa, this inflation story is serious. Good morning. Finally, he woke up. It's serious. All right. Yeah. So then the bond market generally works on it's a very forward-looking market. So it goes like, oh God, they're turning. So it anticipates their move. And then the Federal Reserve came in and reinforced this stance, right? So what happens is that bond yields move higher across the yield curve. And they move higher to basically incorporate the future expectations that the Federal Reserve is going to hike rates at a certain level. Mm-hmm. But why is that important? Because let's say a 5-year bond yield reflects the next 5 year of federal funds rate, the path for the next 5 years, Mark. So we start at 0. According to markets, well, we read it very hard, but up to last week, we would go up to 4% Fed funds rate by 2024, and then we would slowly converge back to 2.5%, 3%. So let's say a 5-year rate was at 3% or so. Let's call it the average of that, right? Why is that important? Because that 5-year rate was 1% a few months earlier. And when a corporate or even a guy like us wants to get a mortgage, he gets priced on the US Treasury yield plus a credit spread. Mm-hmm. So if US Treasury yields move from 1% to 3%, your borrowing cost, our borrowing cost, the real economy borrowing cost, moves up immediately. The Federal Reserve hasn't even hiked yet. But there it's where I disagree with Jeff Snyder. It has an impact on the real economy. The forward guidance has immediately an impact on us because when we go and borrow, it's much more expensive to borrow. So Mark, when we go and buy a house now, let's say the house hasn't changed value. It's still $1 million. But instead of borrowing with a 30-year mortgage rate at 3%, you now borrow at 6%. So what it means is that your monthly mortgage installment is much, much higher. So can you afford that? Has your salary gone up that much? Well, not really. Adjusted for inflation, your salary has gone down. So what it means is those borrowing costs immediately affect your decision making. You're going to be saying, yeah, but sorry, I can't afford that. Which means the house listed for $1 million doesn't find buyers at $1 million. At the new borrowing rate, it needs to find buyers at a lower house price. So you can immediately see how this reflects into decision making, whether corporates are going to borrow or not. That's another thing. If I am a high yield junk corporate, Mark, over the last year, I was basically blessed. I could borrow at 4%, 3%. Now I have to borrow at 8%, 10% in the US. Is my business model viable at 10%?
Right.
If it's not, what am I going to do?
Yeah.
Instead of investing, I'm going to maybe cut some investments. I'm going to cut some people. I'm going to fire some guys. So you can see it does have an impact on the real economy immediately.
Of course, it's it's the price of money. And so we base our decisions based off of what that money, the price of everything, right? And so that's the price of money that they're setting. And so we're basically buying $1 million today that we're going to pay back in the future. And that interest rate is the price for us to get that $1 million that we're buying today. I'm curious. I mean, you used mortgage rates going from 3 to 6%, which is, I mean, that's where we're at. They've come down just a little bit from there. But if we look at, this, and this is another Jeff Snyder thing, the fable. He calls it a fable. He's done a couple of videos on it. The fable of Volcker raising rates and stopping inflation. The euro-dollar market's too big, and supposedly that doesn't have any effect on it. But the fable goes that Volcker, doubled the inflation rate. Or I'm sorry, the Fed funds rate, from 10 to almost 20%, and that tamed inflation. What I'm curious, your viewpoint on is it the total number from 10 to 20, or is it the size of the move as it was a 100% increase? Because today the Fed has been doing 0.5, 0.75, which is nothing. But in terms of the size of the move, it's equal, if not more, than what Volcker did at the time. And if these corporations are pricing that money, and maybe they're stretched where we can just afford this amount, if you double the price of money, whether it's from 1 to 3 or 1 to 2 or 10 to 20, is that sort of the same?
So this is an exceptionally phrased question, Mark, because the rate of change in macroeconomics and the change against the so-called equilibrium rates, it matters as much as the absolute change. Mm-hmm. So let me try to explain. On the Macro Compass, which is my free newsletter, I put out an article, I think a month ago, in the series. It's called the Bond Market 101 series. I try to explain to people how the bond market works. So people have to first understand that the equilibrium interest rates that we have today are far off than the one that we had when Volcker was there. So the equilibrium interest rate is an interest rate at which the economy runs at its potential, Mark. It doesn't overeat, it doesn't go into a recession. It's an interest rate at which we just run. The economy runs normally. This equilibrium long-term interest rate is driven by demographics and productivity, mostly. But the demographic trends we had back into the Volcker era were very different than the demographics we have today. We had so many kids actually entering the labor force when Volcker was there. Mm-hmm. And right now, if I look at the US labor force, it's growing at 0% year over year. There are no new people entering the labor force. Productivity trends are stable, but that means that the equilibrium trend rate at which the economy can run is lower today than it was in the past, which also means, Mark, that changes of interest rates today are much more relevant, even small changes are much more important for the economy because the equilibrium rate is much lower. So effectively, if you move rates today from 0% to 3%, it is a large move, almost as large, I calculated, to a move which was equivalent to a move from 0 to 6% when Volcker was there, because the equilibrium rate has become much lower. So when you make moves around this equilibrium, they impact the real economy very, very hard immediately. And you can also see it in financial markets. I mean, we can make all this smart assessment, but in reality, markets and the price of things is telling us something.
Right.
It's telling us that a highly valued, high multiple tech stock or ARK, for example, if the price of money changes from 1% to 4%, hey, there's quite a difference on these earnings that are projected for the next 20 to 30 years. So things like assets are telling us that these changes, even if they seem small in absolute terms, because of the rate of change, which is very fast, and because of equilibrium rates being much lower than they were in the 80s, are indeed very important. I do agree with you.
So then you're saying it is about equal. It could be equal because of the rate of change versus the absolute change.
So basically, when Volcker was at the Fed, the equilibrium real interest rate was, in my estimate, around 4% in real terms after inflation, right?
Okay.
So in order to tame inflation, what it is that it brought it all the way up to 6 or 7% in real terms, right? So today, the equilibrium real interest rates for the US is 0% nowadays. So the US economy can run at its potential GDP, sort of generates a 2% GDP growth if real rates are at 0%. If they're below that, it gets stimulated somehow. If they're above that, it gets slowed down. So today, the Federal Reserve is promising us to bring real interest rate to positive. Powell told us they need to be positive. You guys have to slow down. He's telling us very clearly that he wants us to slow down, and very hard actually, if you ask him. And so a move from real interest rates, they were like minus 2% in 2021. If you move them from -2 to +1, that's a really sizable move given that equilibrium real interest rates are at 0%.
Right.
Not exactly a Volcker-like move, but we hit relatively close if you take into account the rate of change.
Got it. Got it. So then everybody's asking the question, is the Fed put still on, or more specifically, people are trying to wonder when the Fed will pivot off of this. I've been thinking that they don't care. I think Powell has told us as much. They don't really care about the economy or the markets, right? They're really focused on this inflation number. And so it looks like they probably won't pivot until they see some meaningful change in this inflation number. Maybe, going from 8.5 to 7.5 to 6.5 or something like that. And then maybe they'll start to affect change their forward guidance on the increase of the Fed funds rate. What are you thinking in terms of when will the Fed maybe come off of their decision? If they're not too dug into their position like they have been in the past.
December 2021, another article on the Macro Compass was called "The Bears Are Knocking on the Door," and I there said the Fed put doesn't exist. I got so much negative comments like, "Are you nuts?"
Never existed or doesn't exist anymore?
Doesn't exist anymore.
Okay.
It did exist. It was very strong, but now it doesn't exist anymore.
Got it.
And people told me, "Alf, you must be crazy." I mean, the Fed put has existed, has been the backbone of markets since 2008, effectively, right? Well, there's quite a difference. From 2008 to 2021, we never saw inflation above 2% on a sustained basis, and neither we saw inflation expectations above 2%. So we now have both. We have spot inflation above 2% and consumers actually getting a little bit more worried about inflationary prospects down the road. If you're a central banker, Mark, that's terrible. That's like the last thing you want to see. Because these guys, I talk to them in so many conferences, they think as follows. It's very funny. If inflation and inflation expectations are between 1 and 3%, they're okay. They're like, okay, if they go up, we're going to tighten a little bit, but linearly. If they move down within this band, we're going to accommodate a bit. It's all very controlled. It's a status quo. They like controllable things, status quos. Now, if you go too much close to the right end of this band that I defined, so let's say spot inflation goes at 4%, 5%, and inflation expectations on top also start to reflect the probability that this 4-5% inflation will persist. Wow, the reaction function moves. It's not linear anymore. It becomes like convex. They're like, look, I'm going to tighten very, very hard. You don't believe me? I'm going to tighten even harder. I'm going to make you believe that I'm going to take things and make them back into this band we discussed before.
Right.
They really strive for controllable environment, something they can be comfortable with. And we had nothing but that. Still, we don't have anything but that, if you ask me. So they're not going to stop until actual inflation slows down. And how you measure that is by month-on-month rate of change in inflation.
Right.
Because year-over-year can be distorted. Used cars, oil prices. There are a lot of these base effects if you compare inflation to last year. So they will be comparing it to last month. And they want to see inflation slowing down on a month-on-month basis. And people are like, Alf, but inflation is like the most lagging indicator ever. In an economy, you slow down the housing market, you slow down, you see PMIs going down, you see service going down, you see the labor market cracking, you see GDP slowing, and then finally you see inflation slowing down. That's normally how it works. Right. So if these guys wait for inflation to slow down, it's going to be way too late.
Right.
Yes, pretty much it's going to be way too late.
Yeah. Yeah, all that assumes that is a false assumption, in my opinion. The markets, I don't believe, are a engine that can be built and managed. It's an organic thing that can't be controlled, and I think that's my opinion. I think it's also proven. If you look back of the booms and busts for the last 150 years, you can see that the booms and busts have only gotten bigger, and specifically from 1913 when the Fed was created, and now the booms and busts just get bigger, 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 and it's because of this constant overreaction. 2018. Jerome Powell said, we can't get the inflation. We can't get 2%. 2019, we can't get inflation. 2020, we can't get inflation. They said, we're going to let it run hot. And I think at the time they were thinking, if we get to 4 or 5%, that's okay. We'll average it down with the years we've had less than 2%, but they got 9. Right? And so like now they're like, well, shoot, we were hoping for 2. We ended up at 9 or whatever, 8.6. I'm rounding up. So now, well, shoot, let's get back down to 2. We're committed. But then how much do they overreact to the downside now?
Yeah, so the downside is, the thing is people are used to see them rescuing stock markets, right? Or credit spreads, that's the other thing. If corporates don't have access anymore to the market, they can't borrow anymore, Mark, then the Federal Reserve gets very nervous. Because they don't want people not being able to buy a house anymore, or corporates not being able to refinance their business model anymore. That's not what they want. But in this case, what are they going to do? If inflation is still at 7% and the stock market drops another 10%, then what are they going to do? They're going to say, oh, we're fine with inflation at 7%. It's going all fine. We can come in and we can do some QE. Of course, they can't do that. So they're between a rock and a hard place. The situation is honestly not easy. Also, the reason why I've been super defensive on stocks.
Yeah.
If you ask me, are you buying any? The answer is still no, because unfortunately, we'll have to see things get a little bit worse before they get better.
Yeah. Now, you talked about how they really try to project what they're doing, and of course, they've given this dot plot out multiple years. It seems like they're really trying to tell the markets months in advance what they're going to do, so there's no surprises there. And so they've projected out that they're going to be aggressive on raising rates over the next couple of years, to your point. And then the markets are trying to price that in, right? They're discounting mechanism, so then the markets are pricing that in. Do you think, it seems like we've continued to have bad news after more bad news after more bad news, and it seems like the markets aren't continuing to drop off all this bad news. And so I typically look at, well, the market's not dropping any more off of the bad news. They've projected out for multiple years how bad they're going to get. The market seems to somewhat believe it. They've priced it in. Do you think the markets have priced it in or not yet? They're still thinking the Fed's bluffing.
So last week, we've seen a massive rally in the bond market. So this is the first time, Mark, since November, that the bond market has told Powell, okay, now we have led you to basically tell us that you're going to hike rates to 4%, but now we don't believe you anymore. You're not going to make 4%. So I just released the thread on Twitter. We'll do an article on the Macro Compass to explain that the bond market is basically repriced like 100 basis points, a full 1% in the face of the Fed. And what I mean is, the Fed is telling us next year Fed funds rate are going to be 3.75% at the end of 2023, and the bond market is telling us now that it's going to be 2.75%. It's a full percentage point lower than what the Federal Reserve is implying, which is basically the bond market showing the middle finger almost to the Federal Reserve. It's telling them, guys, you'll have to cut rates very, very soon. You're not going to get there. And the issue with the stock market, on the other hand, is people always associate market. The rally in the bond market means that stock market are going to rally too. Because, you lower discounting rates, you make money cheaper for corporates, you discount cash flows at a lower interest rate, which make your equity price higher. Well, the reality is, what about these earnings? We really haven't had a reprice down in earnings. If you look at earnings expectations, and I'll ask you out of the blue, Mark, just out of the blue, what do you think analysts are expecting for earnings growth this year and next year? Given the economic state, S&P 500 earnings growth, what is that?
The number or the direction? It said directionally would down, I would imagine.
And indeed, it's up 10%. That's analyst expectation.
But I saw yesterday, I was looking at some analysts were saying 10% growth and some were saying massive decline as well. So it seems that I saw that number yesterday, but it seems that the analysts are like way divided on that number.
So there's dispersion of there is no consensus, let's say. But even within the dispersion, if you do a median or an average, you end up at plus 10% this year, plus 10% next year. I'm
Okay.
sorry, what?
Yeah.
10% earnings growth. I don't agree with that. So if the earnings growth shoe falls, then obviously certain pockets of the equity market have to reprice down because, yeah, okay, these earnings might be discounted at the lower rates, but these earnings are not going to be the ones that are priced in right now. They're going to be much lower.
Yeah. Talking about that, I didn't want to spend a lot of time talking about equities, but talking about the stocks and the earnings specifically, a question I have is that you have the earnings, which maybe earnings go up, maybe earnings go down. We can talk about that, which we already did. But specifically, stocks have the PE, the earnings, the price to earnings, but then there's a ratio or a multiplier. And so it seems like, well, we know historically that PE number, the multiplier, moves up and down historically. And it's totally possible that you pick an Amazon. Amazon's probably going to be here in a decade. They'll probably be bigger than they are in a decade. And so you go, well, shoot, Amazon's down. It's probably a good buy today. It's certainly going to be bigger in a decade and probably, maybe more profitable. But that multiplier number may not be where it is today. So it's totally possible that Amazon could be bigger and more profitable, but still the stock could be worth less. Right? Do you see that? Do you see that?
I think that Warren Buffett once said that price is what you pay, value is what you get, or something like that.
Yeah.
So the thing is, of course, Amazon is going to be there in 20 years. Nobody's arguing that. I mean,
Right.
it would be really surprising if they're not. So you're buying a stream of earnings. You're buying a stream of profits, right, over the next 20 years. Cool. So let's make assumptions on how these earnings are going to be. Are they going to be higher, going to be lower than expectations? All right. But you asked the right question. How much are you paying for these earnings? That's the PE, right? The price earnings. And actually, the Federal Reserve and the economic conditions have quite an impact on this price earnings ratio. Because the Federal Reserve, by setting the price of money, by setting the price of risk-free money, of an instrument you can buy and you know you're going to get paid because it's the liability of the government, like it's a treasury bond. So normally you get paid back in most cases, right? So by setting the price of that...
Depends on who you've given the money to, but yeah, you hope so.
That's a fair point. Fair point. But generally speaking, that's considered to be a risk-free form of money. So it's like they set a price for a sort of a benchmark you can use. If that price is 1%, you're going to be quite incentivized to look for opportunities, right? What can I do? Can I buy a house? Can I buy Amazon stocks?
Right.
And so that's going to incentivize you to be more aggressive. It's going to increase these PEs because more people will chase risk assets. On the other hand, when this risk-free rate becomes 3% all of a sudden, then the opposite is going to happen. Everybody who thought that buying ARK or Peloton or whatever that is at incredible valuations right now are like, well, maybe a 3% treasury yield is not that bad. Actually, it's less risky, less volatile, ensures me I can get some money back and a 3% return. And so they pare back on these investments. They bring down PE. And even if earnings are okay down the road, if you overpaid for these earnings, that can be very painful.
Right, on the wrong multiplier. So, shoot, man, so much to get through here. So let's talk about sticking with bonds. Let's talk about, we have some bombs that are about to go off globally. So there's the Asian DXY that's looking horrible. The Hong Kong peg, that's in danger. We have the Japanese bond situation that's looking really, really dire. And then in Europe, I mean, the ECB's in serious trouble. The whole Credit Suisse problem with exposure to the pigs. 3 big bombs. Which one should we jump on first?
Oh, Mark, that's so much. So let's do. Shall we do Europe? I mean, given my Italian accent and given I'm in Europe, maybe it can help. So let's do Europe. Then maybe we do Japan, because it's also very, very important for the global economy and global bond markets. But let's do Europe first. So where do we start? So let's talk about the architecture of Europe, to actually give a background for people to understand why things are really fucked up here. Can I say fucked up on your show?
Why not?
Great. So how it works is Europe is a bunch of 19 countries that have one currency. They can set their fiscal policies somehow as they want, but within certain rules that is set by a certain commission. But the monetary policy, they have no say. There is one entity, which is the European Central Bank, which sets the same monetary policy for 19 different countries with a different fiscal policy. Does it sound good? No.
Well, it depends. It depends. It sounds good for Greece, not so good for Germany.
So what happens is the following. all these
That's
countries
like
are obviously.
that's like if you're in university and your teacher was going to average out all your grades. Well, it's great if you're the guy that wants to party and not study, but if you're the one that wants to get a scholarship, it's not so good, right?
Yes. So all these countries as well have different features. So you'll have, for instance, Italy. Before entering the Eurozone, the model was, okay, we are good at doing stuff. We can export a lot of stuff. We produce goods that people really want abroad. So what are we going to do is we're going to make our currency cheaper so that they can come in and buy it, and it looks for them extremely cheap to do this, and we're going to then do more exports. That's what Italy used to do. It's the good old emerging market model. Weaken your currency, produce goods that people want out there, and actually sell them. Right? But you need to have control on your currency, on your fiscal policy, on your monetary policy to be able to sort of engineer this business model, which is risky, but you can try and do that. If you enter the Eurozone, you can't do that anymore. Germany, on the other hand, has a business model which was also export-oriented, but from another perspective. The Netherlands, a completely different country. Anyway, you get my point, right?
Yeah.
And now what happens is all of these countries are net importer of energy and commodities in general. All of them.
One.
More or less, but all of them, net importer, big times. Big times from Russia, by the way, when it comes to natural gas and oil. And now you have a war, and then the exporter of this tells you, I'm sorry guys, doesn't work anymore, there is a war. We're not going to export anything to you anymore. So the marginal price of this natural gas, electricity, oil, they go through the roof. And this brings inflation through the roof as well. And now you have a monetary policy which has been set for a decade, roughly a decade, to make sure that the most vulnerable countries within that bloc actually could survive. That's Italy, that's Greece, that's Spain, Portugal, etc., etc.
The pigs.
Now, yeah, the good old pigs. So these countries actually required even lower rates, if you ask me, than the one that they were set. But they had to live with what was set to make Germany, the Netherlands, Austria, Finland happy. It's a compromise. The Eurozone as a whole, it's a compromise. Now this compromise can't stand anymore because inflation is at 5%, 6% in the Eurozone as well. So the ECB has to try and do something. There is quite a disproportionate impact if you bring interest rates a little bit higher on Italy, Greece, Spain, Portugal. They weigh so much if they're a little bit higher than they are already. So guess what? As investors go and chase this. They start selling all these Italian bonds, all these Spanish bonds, all these Greek bonds. And so they basically ask the ECB, they're literally asking the ECB, Mark, what are you going to do? Are you going to be serious about fighting inflation? Are you going to be serious about increasing interest rates? Or do you instead want to make sure that things don't implode and you're going to again back up Italy, Spain, Portugal, etc.? But if you back them up, how do you back them up? If you do QE with inflation at 5%, we are not going to like that either. So what are you going to do? And the answer is basically the ECB has no answer. And euro dollar today, it's 102.
Well, Christine Lagarde threw out this fragmentation policy.
Yeah, cool. So, I mean, I say cool because I know these guys. I mean, the German Constitutional Court in Germany has already opposed quantitative easing for years. In multiple occasions, they came out and tried basically to challenge the European Central Bank by telling them quantitative easing is not the thing they should do to the extent they're doing and with the methodologies they're doing, which sometimes they deem almost unconstitutional in Germany. Now, the anti-fragmentation tool, do you know, the solution which was floated, and sorry if I'm laughing, is that from the maturities of previous QE investments, Mark, they have bought German bonds, Spanish bonds, Italian bonds. They will take German bonds, they will not reinvest those, they will take the proceeds from these bonds that mature and buy Italian government bonds with those. All Spanish, Italian, Greek government bonds they can buy. Now, they could try and do that, but there are two problems. The first is to do that, you have to wait for a German government bond to mature so that the cash comes in and you can buy an Italian government bond. Well, investors trying to chase you are not going to wait. They're just going to sell Italian government bonds every single day. And you need an answer for that every single day, not waiting for a German government bond to mature to be able to, to close down, to water down the fire. And the second is that the Constitutional Court in Germany is definitely going to challenge that. So Europe is a compromise place with a bunch of political hurdles to fight at the same time, while we're trying to set a monetary policy that doesn't make anybody happy, and we have inflation at 5 or 6%, investors keep asking questions, and euro dollar is almost going to parity. That's great.
And if these pigs nations don't get bailed out, then there's massive contagion with some of the banks like Credit Suisse that could blow up and sink the whole thing.
Well, actually, Credit Suisse is one example, but let's go back and let's try to tie some parts of this conversation. Do you remember when I told you, Mark, that when banks are flooded with reserves, they then go and look for opportunities to deploy these reserves to actually invest in something? I don't want to own too many of those.
Right.
If you're a European bank, you have been inundated by reserves over the last years because the ECB did a lot of QE. There are, I think last time I checked, 4.5 trillion euros, that's a lot of zeros, of excess reserves in the European banking system, which meant that some of these banks, even Northern European banks, even the ones you would think they are safer, actually to find some yield, they went and invested in Greek bonds, in Italian bonds, in Spanish bonds. So it's not only certain banks, it's actually a lot of these banks have exposure to a lot of these peripheral government bonds. It's all one tied financial sector. Also asset managers, pension funds, for the same reason, to find some yield, they went and they invested in these weaker countries. So there are contagions. There are contagion risks that can actually be pretty large, and they're not only limited to Credit Suisse.
Yeah, man, so much to cover, so little time. We'll have to do another one of these, but let's see. So we're probably not going to jump into China, the Asian DXY, and Japan. Those are big problems on their own. But it looks like if we just stick with Europe, because that's a big one. So all of Europe has become a net importer of energy, to your point. That's self-inflicted. They've decided not to get their own natural gas out of the ground, or they've decided to shut off their nuclear power, as in Germany. And then we saw Germany, which has been the economic engine, has now become a net importer, which isn't good for that. So we got big problems over there. And then we have the problem back to energy. So then we have this Russia-Ukraine situation. And so we see that they're all basically needing this energy. They're all net importers of natural gas. Natural gas prices have gone through the roof, which then have all these knock-on effects, fertilizer, food, etc. And they're basically dependent on Russia, on Putin, to now get that energy. And they seem to be taking a pretty hardline stance on this. Like, yes, we're with NATO. We're going to transition away from it, which we know isn't going to happen. They did announce that maybe the EU is going to classify nuclear and natural gas as green, but that's probably going to take years to happen, if at all. So I guess the question I have is, what do you think happens over the next year or a couple years with this dire situation where, as you said, it's about a 10-year-old agreement. You have Germany trying to prop up countries like Italy and Greece. But now it's really been exaggerated because of this net energy importer situation. And being a part of NATO, they're going to have to make a very tough decision, which in the summer isn't such a tough decision. They can say, we don't need the natural gas in the summertime. What happens in the wintertime when they need that natural gas or people freeze to death? And does this whole EU NATO thing just break apart and the bond situation implodes? Or does the United States, or will the U.S. basically have to just come in and buy up all the EU sovereign debt in order to try to solve this situation?
So
it's a big question. I know. Sorry.
It's a big one. So the problem with natural gas and oil in Europe is that you can't get it elsewhere very quickly. It's like you need it literally from that source. Your pipelines are built to actually warehouse energy and gas from exactly that source that you can't trade it with right now. So when I hear government saying that they're going to cap the price of oil or gas, it's laughable. I mean, you can cap whatever you want. At some point, it's about how much gas and how much oil do you have, especially for gas and electricity. That can be a problem. So I'm afraid, Mark, I don't have a straight answer to your question because it basically depends on one variable that I can't control or model, which is how Russia is going to decide to handle that. They are and also how Europe is going to try to be on the hard line or actually soften up their stance and try to get some transaction done when it comes to gas. it's a very uncomfortable situation. And if you look at stuff like there are forward electricity contracts for Germany, so you can basically try and lock in prices for electricity next year, effectively 1 year ahead. These prices are record high every single week, so it's not looking good. I don't see an easy solution, to be honest. It's reflected in euro dollar, and I look at that because that's the release valve. It's the biggest market in the world in terms of FX. And so if you try to tell people, well, we're going to defend BTPs, Italian government bonds, then the next release valve becomes the euro dollar, because that's how markets work. They're going to try and chase the narrative as much as they can. I can't see a positive solution to that, to be honest. I can't see it. There is somebody that said once, and is completely right, that central banks, well, print a weird form of money. We call it reserves. They definitely can't print gas or oil, and that can be pretty tricky. I honestly am pretty worried from this side how this is going to be solved. I don't have an answer to the question. I'm sorry.
Yeah, and of course, you don't have a crystal ball. I'm sure it'd make it much easier if you did. But I guess just the way that we're framing it up to the point of you have this 10-year-old economic European Union, you have countries that are desperately needing some sort of a bailout, while other countries don't want to give the bailout. The countries that don't want to give the bailout, but they're in the same boat as the other ones, which is they need this energy, but inflation's raging so high, and so something's going to give. It looks like there's probably the ECB collapse, European bond collapse. And so do each nation basically kind of each man for themselves? Or is it going to require a massive bailout from the U.S.? And do you think the Fed would step in and buy all that sovereign debt? So I know you don't have a crystal ball. Do you have any opinion, or do you want to guess which way it falls? Or do you think that it doesn't even get to that? Maybe I'm overstepping, and maybe they'll figure out a way to navigate this, and it's not that big of a deal.
So the only thing I can say that is tying to the US, and it's a very smart connection from your side, is that Europe is a geopolitical imperative. Like, we have witnessed a situation in Europe where we seem to be extremely close to, on the brink of breaking down as a project, and we never did at the end. You throw all the politicians in a room for 2 days and they come up with a solution, because there is a geopolitical imperative to keep Europe, both a military but also a negotiation, a geopolitical project which is too big to fall apart, I would say. Also for the US interests behind that, NATO and so on and so forth. So if I have to think about a situation where Europe implodes because of that, I find it hard to believe. But in the past, all these problems were mostly financial problems.
So you find but you find it hard to believe. You don't think that Europe's in danger of blowing up economically. I know we're talking like geopolitical, but it seems that the catalyst is the economic catalyst back to the bonds, right? Like these nations, can they stay up, and can Europe continue to support them? So it's a geopolitical question, but it looks like the catalyst being this economic situation. So you're saying that you think that maybe it's not that bad, and maybe the economic situation, they can kind of figure it out?
On the economic front, if it was purely financial, so if it was something to be rescued from a financial perspective, I would have been extremely positive on the fact that ultimately Europe would have found a way to engineer something, because the Germans can scream as much as they want, but they also have a vested interest not to make this implode. When it comes to financials, Mark, that remains true. The problem is that in this case, there is the energy, there is the physical world problem in this case that the Germans can't solve and the Italians can't solve.
Right.
And that is the part that complicates the equation, where unfortunately I don't have an answer. But if it would come only to financials, I'm sure they would find a way to stick together. A very painful and long process, so a lot of pain before we get there. But if you ask me as a European, do you think from a financial perspective that let everything blow up? No, I really don't think so. It's too important for everybody to keep it afloat.
Yeah, we don't know. But, this is where, as I've been saying, that this is where reality starts smacking people in the face. You can have these policies, you can have these financial policies, you can have these ESG policies, these clean, green energy policies, but at the end of the day, you have reality. And so with enough money and technology, I could suspend gravity for a little bit, but gravity's still there and I still have to respect it. And with enough money and engineering, I can suspend the fact that I don't have to produce. I can just consume without producing. But at the end of the day, reality comes back to no, if you don't sow, you don't reap. And that's just reality. And so we're looking at it from a financial standpoint, but unfortunately we have, to your point, these physical limitations such as we need energy. And so
Yes.
to the comment you've said, right, you can't print food and you can't print energy. And so you need those things. And so, these are very complicated issues. Man, I wanted to really ask you, I want to ask you another question. Do you have a hard stop?
No,
Okay.
I don't.
I'm going to wrap it up here for everybody listening. We're going to wrap it up. I got two more questions. I list on your podcast. By the way, we'll link to that down below if anybody wants to listen to his Alf's podcast. You like to throw out a trade idea, so I was going to ask you about that. But before we jump into that, are commodities rolling over? Is the market rotation over? Are commodities rolling over, or are they just correcting after a long run?
So you like to ask very easy questions to your audience.
Hey, I got to take advantage of you while I got you here.
You're right. You're right, Mark. Let's talk business. So from a trades perspective, in the last piece of the macro compass, that's where I post all my trades. I went long bonds for the first time since I can remember. I think it was like early 2021 when I was long bonds. So the reason why I went long bonds, especially the long end part of the bond curve, is exactly because I think that we're getting closer and closer to a recession. The probability of a recession is increasing, Mark. And the more the Federal Reserve remains tight in the face of a clearly slowing down economy, the more they increase the chances, the probability a recession is going to hit us. If a recession hits us, I'm sorry, but rates are not going to be 3 and 4%. They are priced to be 3 and 4%. So if you buy bonds today, great, you get that pricing. But ultimately, when rates are going to go back to 0%, you're going to enjoy those rates you locked in. Commodities are a key part of that thesis because in Europe, most of the inflation is commodity driven. In the US, it is also demand driven. It's really, all these stimulus checks that were sent away to Americans. Now they're fading away. But before that, part of it was demand driven. If you get commodities right, you get the macro right. Part of the commodity rally we have seen, huge commodity rally between 2020 and 2022, was due to supply bottlenecks, was due to impaired supply chains. You couldn't get your hands on some of this stuff. It was literally impossible. And for some of them, it's still true to a certain extent. Natural gas, clear example, right? We just discussed that. Mm-hmm. But what about all the rest? You can get your hands on copper if you want. Short term, there is no immediate big supply bottleneck on copper. So it is really a demand-supply equation there. And if the economy slows down as it is, and it will continue to slow down because rates are too high, the economy can't take it, there is no fiscal stimulus anymore. We are slowing down. The crossroad between demand and supply for these commodities, actually, the balance is much lower than it was before. And we are seeing that copper is down 25% in a month, Mark, 25% in a month. All the other agricultural commodities are dropping too. Industrial metals are dropping too. To me, it is another signal that the economy is slowing down. And rather than expressing it with commodities, I think it's a better risk reward now to go and buy some 30-year bonds, 10-year bonds that are above 3%, rates that we haven't seen for a while. And they are there because the Federal Reserve is promising that they will keep on tightening. They will keep on tightening, Mark. How can they tighten when we go into a recession? And commodities have maybe rolled over. And also maybe some of this inflation we see now is starting to decelerate because, hey, they've done enough damage. They've done so much damage at that point that maybe inflation slows down too. So bonds are basically the main thing I want to have in a portfolio right now. It's hard to say, given they're promising to hike rates, but this promise is already in the price of bonds. So when you buy them today, you're effectively locking in these rates and you're betting on the fact that the recession hits us sooner rather than later. And so you can enjoy these rates you have locked in for a long time.
The one thing I'll remind everybody listening is that the one thing that he's leaving out and we're not actually getting into because we're running out of time here is over what time frame. So, at this last conference I was speaking at, I told everyone, I said, hey, one thing to keep in mind, you're going to hear people talking about one guy's pro this, one guy's con this, et cetera. Mm-hmm. They probably both see the same thing, but they're looking at different time frames. So I would just remind everybody to think about that. I would say long term, are we going to continue to need oil and natural gas? Yes. Long term, are we going to have enough supplies of it? Probably not. Why? Because they're shutting down investments on it, right? So long term. In the short term, right, it's different. Now, we'll go ahead and wrap it up with, by the way, shout out to your newsletter, the Macro Compass. We'll link to that down below. I had asked you, because on your podcast, you like to throw out trade ideas. You said you just put something out in the Macro newsletter. So if you want to say what that is, or what's the trade idea that you can leave us with?
So there are,
and if you don't, and if you don't mind, over what time frame?
Of course. So there are two basically. One is to buy bonds, and that will work on a 3 to 6 months time frame. So again, it's very important, Mark, and I really appreciate what you did there. I have two books. I have one is a let's say a more tactical book. It's really trades that should work over a 1 to 3 months horizon. The other one is a longer one. You can buy these assets and keep, in my opinion, keep them on the book for a year. More than a year actually, and they'll keep making money for you, or at least provide some diversification benefits to your portfolio. So the bond thing that I just discussed, actually, I think it's valid for the more structural portfolio, the longer term one. I think it's a good entry point to buy back some bonds. We didn't have the chance to buy it above 3% for a while, and as the economy is slowing down, I think it's a good idea to ride down this recession process by having some bonds in your portfolio. The more short-term trade idea there is to remain short equities. We didn't discuss that for long, but guys, earnings are coming down. They will be coming down. They are not priced to come down. They will. And the Federal Reserve will turn dovish very late in the cycle because they're looking at the wrong thing, Mark. They're looking at inflation. Inflation is the most lagging indicator we have. Everything else needs to slow down before inflation does. So if you're looking for a more tactical trade, I think over the next 3 months, the pain in equities is not over yet, unfortunately. Also for other asset classes, not only equities, but anything that is very risky, anything that benefited a lot from all this QE, from all this liquidity inundation in the market, now unfortunately has to reprice down.
Great. Appreciate that. That's good information. And like I said, shout out to your newsletter, the Macro Compass. We'll link to that down below. Man, I wanted to talk about, we still didn't get to talk about the Asian DXY, the Hong Kong peg, Japan's bonds, which are a really big problem. I wanted to talk to you about U.S. real estate. You had put some charts up recently that I don't know if I agree with. I wanted to push back on that a little bit. Okay. I want to talk about this whole Russia BRICS and how that affects what's happening. And I wanted to get into CBDCs and Bitcoin. Of course, I have to talk about that, but we didn't have time for any of that. So we're going to have you back on at some point in the future, and we'll dig into that stuff. Anyway, I'll appreciate that. Anything you want to shout out or bring attention to while we're here?
Very kind, Mark, but the easy fix for that is to have another episode of this. It's been a great pleasure to be here. I just wanted to say, as you said before, if people want to, read a bit more about what I do, I have a free newsletter. It's called the Macro Compass. You can just Google it, and it will appear. I have a podcast, as you said before. It's called the Macro Trading Floor. Every Sunday we put out with a guest a trade idea, something that is actionable over the medium term, 3 to 6 months. So we discuss it. I think it's a cool format, and that's basically it. For the rest, I would like to thank people for listening to us for an hour? Thank you, guys.
It's been about an hour. All right, Alf. Appreciate it. It was long overdue. I enjoyed it. We'll have you back for those topics soon. With that, thanks so much.
Thank you, Mark.
All right, hopefully you enjoyed that conversation with Alf as much as I did. I know I get a little ambitious with my questions. It's just because I have a lot. We didn't get through them all, but we'll tease it up for the next one that's coming soon. If you haven't already, check out Alf's newsletter. There's a link down below, the Macro Compass. It's definitely worth checking out. As always, share this, right? We're trying to get these ideas into the hands of more people. That's why Alf left his $20 billion fund to try to help get these ideas. So share it. Hit that like button at least so more people see the video. If you're not subscribed to the channel, do that. Just click on that subscribe button. And of course, let me know what you think. Leave a comment. That's what I got for you today. To your success. I'm out. Since you've stayed to the end, I know you like this video, which means you're probably going to really like this video right here and this video right here.